Good morning, everyone, and happy 1st of May today, May 1st today. Believe it or not, we're almost halfway through the year. Hey, today's newsletter we're sending out, we try not to send a whole lot of these things out, but when we do, we try to make sure they have some purpose and some meaning to them. Today's topic is basically this last week, the Consumer Confidence Survey came out from the University of Michigan. Pretty dire. We'll go through a couple of charts of that. So sentiment is in the toilet and the market's at a high. So just some things to be cautious about. I'll share a screen here, but for a quick bit here. Um, so it hits a historic low, what it means for the markets. So these are things we have not seen. 46 was the survey, 53 was a prior survey. Long-term average is 85 to 90% where consumers feel confident about the economy or confident about the future. So month-over-month decline 10%. Lowest value in the survey's 7-year history. So just some things to really kind of pay attention to with with your future expectations of what the world's going to bring us. What's driving the weakness? Inflation's back in focus. My contention for the last few years is we've had a 4-year decline in inflation, which had a lot of different aspects to it. China coming into the new world order, so to speak, was deflationary. The computing power was deflationary. All these things are converging to probably revise that upward over the next 10 years or so. Time will only tell. We have no idea of figuring out what's going to happen with this market just due to inflation. But inflation is pain. And so everybody's going through that right now. Don't care who you are, what income level you are, it is painful. And we're not seeing any backwardizations of that, where we're going to reverse those energy prices, geopolitical risk, which is kind of seen with a lot of these things going on. This thing with Iran, you see the thing in Russia and Ukraine, tensions in China. Global tensions are really probably more to do with structural imbalances, and I believe mainly due to debt. Globally, I think we're about 340 to 350 trillion globally in debt across all countries, and good old USA being the largest holder of that debt. We're about 50 trillion in debt, and that's probably set to explode here in the coming future. Personal finances are deteriorating. That's terrible. We have seen that. I've had a kind of a former colleague of mine get with me this last week. He is desperate. He said, "I'm desperate. I need something. There's nothing to do." And when you squander your opportunity, spending too much money, so forth, it is terrible what's going on out there. Expectations are rolling over, so forward-looking expectations fell to levels not seen since 1980. And guess what that represented? 1980 was after we had a 10-year rout of inflation from really the early 70s to the early 80s. And so that's something probably telling. We'll have a couple of charts in. Let's stop sharing this one. We'll start sharing a different one over here. Let's do this share right here. So this is just the graph between the stark difference between the S&P and the University of Michigan survey. So we have the S&P at all-time highs up here, and odds sentiment is way down here. So that is a big kind of what we call a K. Sentiment has usually kind of tracked the markets typically. People feel good about themselves and the market, because I got a good job, I can save some money. And that confidence kind of follows the market. This is the first time we had a divergence, really starting when? Starting right during COVID. And that's when the world changed. And I doubt we ever get back to that old world. You talk to anybody in business, anybody working for a business under stress, it's not the same as it was pre-COVID. Everything's a little bit tighter. I can tell you that. That's something to pay attention. That'll be in the newsletter. Also, we have something in here on the Buffett. We updated the Buffett indicator, which is just kind of like having fun with that Buffett indicator. Kind of tells us where we are with the world. Let's go find that. This is as of December 31st of 2025. Buffett's just a simple way of looking at the value of the market versus the value of the GDP, our output here in America. So right now we are 200, at least we're probably higher than that now, but at the end of the year, we were 230% ratio of the market's value over the value of our economy, right? So just going back to the 50s, we've never hit this before. So again, with 2 standard deviations above valuation, 75% higher than the long-term trend, which is this line right here. That probably represents just a growing economy over the years. That's the trend line. We are up here at stratospheric levels. What can happen? What could go wrong? I mean, probably nothing good, but something to pay attention to as we really try to look at risks first and returns second here. Again, to get back to normal valuation, this is when George Bush came into office. It took markets had to come down twice, dot-com bubble and then real estate bubble to get us down to a valuation level for the economy to the market that represented some decent growth. Now, here at these stratospheric levels, I would just be worried about the future, the next 3 or 4 or 5 years for sure. Anyway, I hope you guys have fun with the newsletter. Hopefully, they're useful. If you have any comments, you have questions you'd like us to answer in this format, please reach back in the comments. So anyway, hope you guys all have a good May. Springtime is out there. It feels great out here in Fresno. Enjoy the weekend, and we'll talk to you guys all soon. Thanks.